Well, hello, everyone. Welcome to After the Close. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you are joining me for this class. So the premise of this class, if you're not familiar with it, is that we have pretended, or we are pretending, that we inherited $1 million and we're looking to invest it. And we're looking at what someone's goals might be, if they had a portfolio, either that they've just decided to start managing themselves, or, if they came into some money and they were looking to build a portfolio. And so that is what we're doing in this class. I'm just bringing up our chat here so that I can see your questions as we go along. Just give me one sec. There we go. And today, what we're going to look at, as the market is trying to decide whether it wants to pull itself up out of the downtrend that it's been in for the last couple of months, where we might look for some opportunities and how we might place those trades. So that's going to be our topic for today. And just let me get here. Sorry, guys. One of my challenges is talking and doing other things at the same time. And it's kind of, life as a coach. So we've got Mike Fairborn with us in the chat. He's a friend and fellow coach, and he understands all of these topics in spades. So if you have any questions, don't hesitate to ask. If you're watching this in the archives, you can always type your questions in down below. My X handle, formerly known as Twitter, is Barb Armstrong CS. Mike's Mike Fairborn CS. We're both posting content there on a daily basis that we think you will find helpful and informative. So I hope you choose to take advantage of that by following us. Just before we get into the thick of things today, I'd like to remind you that everything that we cover in this class is for information purposes only, none of it to be construed as a recommendation on the part of Schwab or myself. We use the Paper Money software application on the Thinkorswim desktop platform, and it is really a great place to learn and hone your skills and be able to practice before considering trading in your live account. We use stop loss orders on occasion in this class, and know that those do not guarantee that you'll get out at a specific price. And there are some other nuances and differences between a paper money and a live account, and we'll go over those as appropriate. So we're going to have a quick look at what's going on in the market. I make that fairly precise because at the beginning of every market day, Kevin Horner, most days of the week at the market open, does a kind of an overview of what's going on in the market. And so I'd refer you to that. And Mike Fairborn also does a weekly class on Wednesdays, kind of a market and sector analysis. And if you want a really in-depth view of that, that is a great place to check that out. And Michael put a link to that class in the chat for you. I'll also put a link in the show notes at the end of this class. So, in this class, we'll look at both some technical analysis and fundamental analysis concepts, depending on the week and what we're doing. We're going to both place some new example trades today and then review some example trades as well. So coming out to the platform, when we look at the S&P 500, one of the things, I have a 1-year chart up. So if we show price as a percentage, we can see that over the last year, this market is up about 12%. And the S&P over the last 30 years, through all the ups and downs, including the Great Recession in 2008 and 9, and I think it was 3 years ago when, this market, the S&P was down about 18% and the NASDAQ was down close to 30. The average annual return has been in the neighborhood of about 11% for the S&P 500. Now, this, is a 1 year going from, last April, May 1st through April 30th. So it isn't a calendar year per se, but, we're up about 12%. And, we had a big pullback here from February 19th through, and what was our date here? Through April 4th. where we pulled back over 20%. And that officially puts us not in correction territory. That, technically happens at 10%, but into bearish territory. And it hit that mark. And now we're seeing this rally. But we've continued to see a lot of volatility in the market. So year to date, we're still down 5%. If we look at the NASDAQ, the numbers are similar, right? So, if we come down here, this was down even more, 25.5%. I mean, that is not nothing, my friends. But, in the last year, up about 14% over the last 12 months. And, last year was really an extraordinary year. And this index over the last 30 years has averaged about a 13% return. So in spite of the fact that we had this recent 25% pullback, which had everybody, holding their breath, from there, when we look at how far we've recovered, the last 18 trading days up almost 20%. And so what a technician might be looking for is us to come back above this 2,500 level, which would coincide with breaking back above the 200-day moving average, now that it's back above the 30. And it gapped up today, closed up 1%. We have Apple coming with earnings today, and I think Amazon as well. So we have a couple of of heavy hitters coming that can influence the market. Because if you come and look at the market watch and you see just how big some of these companies are, this is as part of the S&P 500. These guys, have a big influence on this index. And then when we come to the NASDAQ, I mean, even bigger. So Microsoft and Apple, these guys are heavy hitters. So is NVIDIA, Meta, when you add the two Googles together, Goog and Google, as I like to say. And I don't know if earnings has been announced yet for Apple. So one of the things that you can do if you want to see in the after hours, and we tend to look at this as a longer term investment. So, when we look at this, it's after the market today. But if you did a 1 day, 1 minute, you can see how the market's reacting. And it's reacting pretty positively so far. Okay. But I don't know if the official announcement has come out yet. But stay tuned. It'll be interesting to see how the market reacts to that one. But Google, speaking of heavy hitters, has come out with earnings. And, and so when we look at this stock, it's, and let's look at just a longer term time frame. If we come out and look at the last year, it really has had its ups and downs, right? But if we get rid of these, and we take a look at, like so many other things in the market, Google had a great fall. So it hit this high here. We can get rid of this one too. It hit this high here of 207 back at the beginning of February. And then it's been like Humpty Dumpty rolling down the hill. But it's now crossed back above the 30-day moving average. And when something crosses a resistance line, or something that has been acting as a ceiling, like the 30-day moving average kind of was with Google, when it crosses the river, some say maybe you're better to wait for it to come back and test the ice. And if it doesn't hold, then it wasn't a true breakout, it was a fake out. But if it comes down and bounces, then you can have a higher degree of confidence. And Google has done exactly that. We had a low here and then a higher low. And so when you look at this, you would call this a pennant pattern. And what a chartist or a technical analyst might be doing is looking for it to break either to the upside or the downside. And this one has broken to the upside. And Google as a search engine, it's also become part of our vocabulary. And that isn't saying that as a recommendation. This is a stock that is still down 15% year to date. But if you don't know something, at least my friends will say, Google it. That's what my kids will say. Well, let me Google that. Might we have a degree of confidence that people will continue to look for information using this search engine? And might it behoove us to look at some of the fundamentals? And so if we come to the Analyze tab, and here's just a quick way, because we could also go to schwab.com and sign in and bring up the stock and have a look at it. Now, analysts seem to be looking at this fairly favorably. If you want to see the reports, you can click on it and download that and have a look. It's part of Communication Services, which has remained strong. But this has a pretty big international presence, right? They're not just in the US, they're in Europe, they're in the Middle East, they're in Africa, Canada, Latin America, Asia Pacific. I mean, they're everywhere. And also being a service, it's maybe more, how do I want to say it, agnostic with respect to tariffs, because it's not moving a product back and forth across a border. But when we look at our earnings per share between 23 and 24, it went up from $5.80 a share to $8.04. Now, does that mean it's going to continue to go up? No. This is past performance is not a guarantee of future trend, right? But it did go up by 28% last month. And we can see over the last 5 years, there was, a pullback between 2021 and 2022. But other than that has been kind of uptrending, the same with book value and sales per share. And then a number that at least some investors want to look at is the price earnings ratio. And what does PE ratio means? It means for every dollar of profit, this is how much you have to have invested in this stock. And the 5-year average is $23.22. So for every $23.22 you had invested in Google over the last 5 years, it would have earned $1 of earnings. And right now it's at 17.26. So substantially lower than its 5-year average. And so might this be a time that some might consider, reinvesting in a stock like this? And so then the question you asked, if let's say we had bought Google back here when it crossed the 30-day moving average, or after it came back to retest here, and then when did we get out? Well, maybe we put a stop, we adjusted our stop here and got out here. So we would have had a bit of a nice gain. And then if we said, well, we love this company and what it stands for, and I'm just saying, like, this is the conversation a trader might have in their head. They might say, but my rule says I get back in when it crosses back above the 30-day moving average, for example. And so you'd be sitting here loving Google from where? From the sidelines and waiting. And now it's crossed and it's come back to retest. And so, when I say you want to know when you're getting out of a stock before you get in, and that's both if the trade goes for you and if it goes against you. So had we bought, and this is, I did an example trading plan in our Getting Started with Technical Analysis, and I'll put a link in, I'll show you where you can access it. So let's say we had got in on this day, we would have gone in at, the close of the day was 162.73. So let's say we got in at 163. And then we got out, it would have been nice to say at 207, but very seldom are people that successful in timing it. But let's say our rule is if it goes 3% below, if it closes below the 30-day, we move our stop up to 3% below. So on this day, it was at 190.73 was our low. So 190.73 times 0.97. If we got out, we would have been out at 185. So not on that day. 185. We would have been out on this day here. So this day we would have exited our position. But, you know, if we got out at 185 and we got in at 163, we still made, you know, $22 a share, you know, which isn't nothing. So $22 a share divided by 163, that was still a 14% return. And I'm just looking at a chart and saying, if we had a set of rules and we're following them, this is how that might have played out. And then, you know, now some investors might have just said, I'm going to keep Google forever. And, you know, and they might have ridden it the whole way down. And then, you know, it's coming back up. And that's a choice also. But if we had gotten out here and we're saying, okay, we're going to get back in here, you know, we're buying back in, and let me change our prices percentage back to price. We're getting back in. We got out at 185. We're getting back in for a lower price than what we got in the last time. Okay. So, you know, if we wanted to add to our position, now remember I said, like, know when you're getting out before you get in. And so when are we going to get out if it goes up? Well, when it stops going up. How do we define stops going up? Well, if it closes back below that 30-day moving average. And right when we start, we might just say, well, hey, yesterday we had this low here, or we had this diagonal resistance line. If you want to give it more room, you might say, well, here's this diagonal resistance line. If it goes 3% below that, I want out. You could also look here and say, well, yesterday the low was 155. So if it goes 3% below that, 155 times 0.97. So that would be at 150. So where's our 150 on the chart? Let me just, so we could put a stop. We may want to, because round numbers sometimes are appealing places for stocks to either bounce their head off of. So 150 is down here below this level also. So it would actually be 150.35. And so, you know, maybe we put a stop loss there. Now, does that guarantee that we're going to get out at that price? No. If it gapped down, we could end up out at a lower price. But if our stop is there and we're getting in at 161.30, what's our risk? Well, our risk is $11 a share. Now, this is almost $1 million account. We started with $1 million. We're now at 985. So we're down just over 1%. But if we said we're willing to risk half of 1% on any one trade, that would be about $5,000. So if we're risking $11.30, I'm going to come to my calculator and say, okay, I'm willing to risk $5,000. I'm going to divide that by $11.30. So how many shares could I buy? I could buy 442 shares. Okay. Now, what about position sizing? Well, we've said we don't want any one stock to be more than, and I'm just writing this down, 442 shares based on our max risk. We don't want any one position to be more than 5% of our account. So that would be 50,000. So could we buy 400 shares? No. But if we said, okay, 50,000 divided by 161, that we could buy, say, 300 shares. And we're going to make it a round number just because we want, you know, to have the potential to sell a covered call against it or to add a protective put when the next earnings season comes around. So we're going to come to our trade tab and we are going to right click on this, and it's now in the after hours, but we are going to put this in to fill tomorrow. And so tomorrow morning, I'm going to leave this account open and, oh, actually, Oh, I'm going to do that again. We aren't putting a target in on when to exit. If it keeps going up, are we happy to own this forever? Or, yeah. But might we just adjust our stop, as we watch this go up to manage our risk over time? Okay. So we are going to come to make this good till canceled. We're going to put our stop at 150.35. So I'm going to make that 149.80 just to put it under that 150 mark. And then we're going to buy 300 shares. Confirm and send. And we're going to put this in our growth group. Now, does Google pay a dividend? Well, we're going to look here. They do pay a dividend. It's pretty small, but they 0.5%. But they do pay a dividend. But are we buying it because of the dividend? No, we are not. We are buying it as a growth stock. Okay. Now, let's look also at Dollar Tree. And let's just make sure we don't already have Dollar Tree in our account. And I wouldn't think that we did. And why not? So here are our dividend stocks. And, in total, they're up about $10,000 or about 7%. And you'll notice here it's communication stocks. AEP is a utility. In fact, it says right here, we added sector. So we've got consumer, a consumer staple, a utility, and then 2 communications. And we're adding another communication services. And why are we doing that? Well, when we look at the sectors over the last 3 months, what sectors have been strong? Well, consumer staples, check. Utilities, check. And then at the beginning of the year, and I know that this has kind of fallen out of favor, but communications were pretty strong, and now they're rotating back into favor. And so, these communication stocks, T and Verizon, are in our portfolio. And we'll do more of a review on these next week. I've been gone, as things have worked out, an awful lot of Thursdays so far this year. So we've been a little slow to get our portfolio kind of up and running and invested. So let's have a look at Dollar Tree. And why might we look at Dollar Tree? Because sometimes people would say, well, here's another one that's had a great fall. And so you may say, well, you should buy when things are falling because they're on sale. Well, I have the final, markdowns taken place yet? That's the question I always ask. And then how do you determine if you think that the final markdowns have happened and that it may be turning itself back around? Because here's a stock. I don't know why I have that at, oops. Here's a stock that had a great fall, and then, it traded in this range. It traded in this range from September until about a week ago. And let me just get rid of this one. So, when we look at this, it was trading in this range, and now it has broken out. And so this might be one, if you were looking to generate some income, you could say, well, I would like to buy this, but I'd like to put a target on it. I don't want to do a long-term buy and hold. And when we look at this company and what it does, you might say, well, this one is not tariff agnostic. It's Dollar Tree. It's a lot of inexpensive goods. And a lot of those goods could be coming from China. And so it could be either squeezing their profit margins or driving up their costs. Or they may have to pass on some of those costs. And so that's kind of a negative. But on the other side, might we have more people looking to shop at a Dollar Tree and maybe expand the things that they might buy at a Dollar Tree if their household income, they're trying to manage it by spending less? So then might they go to a Dollar Tree and spend more where they might have shopped another place? And so it might, this demand reduction or people watching their pennies a little more, in fact, end up being a bonus for Dollar Tree. And it depends on whether you look at it as people buying necessary items there versus buying like trivial things there. But it looks like this has now broken out and again come back to retest and is kind of moving to the upside. So could we again do a similar exercise and say, well, here's this old ceiling, which appears to be maybe acting as a new floor. And could we take that $77 level and put a stop? And I'm just using 3% as an example. You could make it 2 or you could make it 5, but we'd have our stop on that at 74.69. And then again, if we can risk up to $5,000, and if we're buying at 81.27, so I take 5,000, and if I'm buying at 81.27 and our stop is at 74.69, let me do that first. 81, let's call it 81.30 minus 74.70. It's about $6.60 a share is the risk we're taking. So I'm going to take 5,000 divided by our 660. This means we could buy 757 shares. But at $80 a share, if we don't want to buy more than $50,000 in any one position, then I'm going to divide that by our 81. So that's saying we could buy more like 600 shares. So we're going to put in an order for 600 shares. And the advantage of a round number, again, is that then we have the ability to sell a covered call. So if it comes up here to 85 and then it looks like it's pulling back, could we sell a covered call? Because, it could come up and then start trading in a range where 77 becomes the new floor. Yeah, and I'd Never Eat here is saying Dollar Tree does have an advantage in that they unloaded Family Dollar, which was hemorrhaging money. And it looks like they beat on their last earnings. And we can always come over here. So they've raised their price target here from, Evercore from 80 to 84 from 79. Here, now we have B of A lowering their price target, raising price target to 103. Wouldn't that be lovely if we're buying it? Citigroup raising price target to 103 from 76. So it seems that the analysts seem to be bullish. And yet there are other analysts lowering price targets. So no guarantees, right? What did they say? The only guarantees are death and taxes. So regardless, we're going to come in here. We're going to look at 700 shares. And we're going to put a stop at 74.69. So we're buying custom with a stop. And if we wanted to I talked about putting a target in, if you wanted to generate income. So what might you base your target on? Well, you could do it based on the width of this range, which is $16. So, from 61 to 77, that's about $16. So we could take 77 and add 16. That would make it 93. So let's put in a target of $93. So we're going to come in and this time buy custom with an OCO bracket. We're going to put in a target of $93. And then we're going to put in an exit of 74.69. We're going to make these good till canceled. And then we're going to change this to 600 shares. And you can see here, we're spending $48,738 to get into this position. There is no transaction fee. We're going to put this in our stocks with targets category and say that the target is based on the width of the channel. Okay. And send that in. Now, tomorrow, if it opens a little higher, and you can see that, the bid here is 80.90 and the ask is 81.23, so you'll want to check this in the morning to just see, if the price is up a little bit or down a little bit. And I wanted to now take a couple of minutes because the last class, we placed a lot of trades with callers. So we can see that Deere really had a good day today. And how do I know that? Well, we're only up $99 on this overall, but the profit and loss today, we were up $1,600. So, and, this was a collared position, but the bid and ask are now closed. So let's come and look at Deere. So we had a protective put and a covered call, and those have now expired. But we do have earnings coming up May 15th. So we might look next week at adding a protective put to that and doing the same idea again. But we'll look at next week kind of where this is sitting. And we'll look at this again next week, but we'll take these off since these are now done. And we can move this, to our growth stock group. But we do have our earnings coming up on that. Now, when we let's look at Kroger. So Kroger, we have 700 shares. And one of the things we may want to add here to our callers is net liquidating value, our caller group. So I'm just going to come here to net liq. And we're going to add that so that we can see the kind of size of our position here. So here's our position. And Kroger, we have a $50,000 position. We're up about $1,100 on this. So we bought it for $70.47. It's currently trading at $72.18. And I think we just added this one a couple of weeks ago, April 4th. So almost a month ago. And our protective put is now only worth 11 cents. We had our put at 65, and we're now on the other side of earnings. Excuse me, it's allergy season. So here's our protective put way down here. And so it's only worth 11 cents or $11 a contract, but we do have several hundred shares, 700. So, it's worth $77 if we decide to buy it back. So we might just say, you know what? I feel that this put has now done what it was meant to do, and I'm going to, close that out. Now, the call has lost about half its value. So we could buy it back to close it out. But if we come out here and we say, well, it's at $75, the 1 year high on this is 73, maybe we give it another week. And with this covered call that we've sold, time decay will work in our favor. With the protective put, time decay will not work in our favor. So we're going to come out to our monitor tab, and we're going to buy back the put. Sorry, we're going to sell the put. And let's just see if we can get our 11 cents for it. And then we'll look at that in the morning and just make sure that that fills. So, we had bought that put for protection. We're saying, yeah, I think we're okay now. I'm just looking at Frankie, are you talking about Apple, the $100 billion buyback and increase in dividend? Word on the street is that Apple has beat. So we could come here to look at Apple, which has been kind of rising nicely after kind of hitting some troubled times, right? And coming to our 1 day, 1 minute. And so, when we look at this, it looks like even though they beat, it's dropping. But who knows where it'll be by morning. Like Apple is one of those stocks. It always slays me that they can have the most amazing earnings report and the stock will, I'm not surprised to see it dropping. It's like, what in the Sam Hill? Yeah. And the Amazon came with earnings. So, the earnings report today sponsored by the letter A, and it looks like it's initially down also. Even though it also beat. And yesterday it was kind of the reverse. We had Microsoft and Meta, and, they both did pretty well today. Like if we come back to our regular charting, Microsoft up almost 7.6% today. And Meta, it gapped up on the open, still closed up 4%. But again, when I think about a company like Meta, and that is Snapchat, Facebook, and Instagram, I know very few people who don't use Facebook or Instagram. Like, a lot of younger people in particular use Instagram and maybe aren't very present on Facebook. A lot of 50 plus people, it seems, have a big presence, or at least look at Facebook, maybe not so much Instagram, but Meta does both. And many people might argue, I know one person who isn't on either. I may know a few, but not that many. But if we come and look at this, again, we had this pullback, and let's see on Meta what the response has been from the analysts. So maintaining a 745, raising price target to 650, maintaining 750. Well, it's sitting at 572 right now. Raising price target to 676, raising price target to 655, lowering target to 640, maintain an overweight. Truist, raise price target to 720. Like that's back where it was in that neighborhood. So, is this another one where, we might want to consider adding this to our portfolio? It's another stock that is in the communications space. So, if we wanted to add this, like 100 shares would be a $57,000 position. And where might we put our stop? Well, we might say, hey, if it came back below, say, yesterday's low, which was 529.50, 529.50 times 0.97, that's 513.61. And the current price, 572.21 minus 572. So that's 58.59 a share. So if we do 100 shares on this, just so that we could sell a covered call or add a protective put, we'd be a little bit over our risk of 0.5% at 5,000. We'd be at 5,859. But if we're willing to take that risk, so Probability Trader is saying, is that what you want to teach to beginners to rely on analyst price targets? No, not at all. So when I'm pointing this out, it's like, hey, what are the analysts saying? And I don't know if it was in this class or I taught Connie Hill's short verticals earlier today, where the analysts seem to be split. And this is what these guys do for a living, is they analyze stocks like this, and about half of them raised the price target and half of them lowered the price target. And so it's like, how do you know what to make of it? It's just, and notice with these price targets, I mean, this one's 700, this one's 664, this one is 720, 640. I mean, they aren't all even very close together. 750, 650. I mean, these are $100 apart. So they can't all be right. But it's just a sense of what's the overall feeling in the market by those that look at this on a daily basis, and how might that inform it? And if we come and look at, you can look at more detailed reports. You can go and read the earnings report, but earnings per share between 2023 and 2024 went up by 37.68%. Sales per share went up, like all of these markers. And these, of course, historical data is no guarantee of future results. We know that. And this one, unlike the other one, is still trading despite the recent pullback. The 5-year average is a PE ratio of 22.7. It's more expensive than that right now. It's at 24.5. That's kind of interesting. But does it mean then we don't think that, this is worthy to invest in? Or, could we do this as a trend trade? We could. Could we say, hey, if it goes back up to 740, that's a really nice gain. I want to take it. I mean, we're going to watch this. We could put in an alert here. So we could put in an alert if we add 100 shares to say, do we consider exiting? At that target. And that's just a note from us to us. We could maybe move this down a little bit. But, close to this previous high. Oh, sorry. I'll make it a little bit lower. So if it goes above, do we sell our shares? And then if we wanted to add those shares, we're going to come to our trade tab, and we're going to look at buying 100 shares, and we're going to have a stop. And where's our stop going to be? Oh, I didn't write it down. Oh yeah, 513.61. Okay. 513.61. Okie dokie. Okay, so confirm and send. And this is a day order, not an extended hours trading order. So this will fill tomorrow. And we're looking for this to add this as a growth stock. Now it does pay a small dividend. But again, that wasn't the purpose of us considering adding this to our account. So we're going to put it in our growth stock group. So just to review, and I'm going to organize these, all of these, working orders here. So we're looking to add a position on Meta, and these are all stock positions, one on Dollar Tree. Now the Dollar Tree is not a trend trade. It's a trade with a target to get out based on the width of the range it just broke out of. And then shares of Google as a stock trend trade. And we went through that exercise of position sizing and looking at if the trade goes against us, we've put stop loss orders in. But with those stop loss orders, there's the recognition that there isn't a guarantee that we'd get out at that requested price, right? Right. So as we wrap, I'd just like to thank you for joining me. Ask that you hit the like button. It helps move this up in the trading algorithms. Ask that you follow Mike and I in the land of X, Mike Fairborn CS and Barb Armstrong CS. and then subscribe to this channel if you haven't done that already. Would be great to see you again next week. Thanks for joining us today. That's the end of our live webcast for today. We'll see you tomorrow morning. Take care, everyone. Bye for now.